Well, I think we're finally getting that rollover we've been talking about for a long time in the market. So stick with me as we talk about why cash is king. My name is Brian Cannon, and welcome to Markets in 5. All right, so this first chart is the S&P 500 index. And during our last episode, I really talked about the fact that this level right here in the bottom dotted red line really needed to hold up in order to feel confident that we weren't going to have further damage. I discussed the fact that it might be, the market might be bouncing between these two red lines, and I had that other red line drawn as well. And sure enough, I'm not saying I knew, I'm just saying it's technical analysis. The market reacts to various levels of support and resistance. And so sure enough, the market just was wildly volatile between these two lines, right? Just kind of bound, up and down these extremely high volatile, days. And so I really wanted to see that line hold and then have it take off to the upside. And I said, if it didn't, we needed to buckle up and be ready. And sure enough, since then, it's just broken it with huge force, lots of volume. So there's definitely a lot of fear still in the marketplace. And, and again, this is why I think try not to get cute, try not to pick too many stocks. You're like, oh, this stock's going to do amazing. Usually when the market goes down, it doesn't matter if you reported excellent earnings last week or not. Most of the times the market will drag down really good companies. And so that's exactly what's happening. So there's plenty of good companies out there. There's just not that many to pick from right now that are trending the way that we want them to be, which is why we're in so much cash. So we don't raise cash just because, we want to raise cash. We raise cash because the positions we're in are breaking down, right? So once they get to a certain level in their trending, we pull the ripcord, right? And we either take the profits or we cut the losses. And I'm speaking mostly in tax deferred accounts. Taxable accounts, we tend to let things ride a little bit longer, but we still have a fair amount of cash in those accounts as well. All right, so just a longer term chart here. You can see that this dates all the way back to 1999 and or 1996, I believe. So, over time, you just have to expect major rollovers. It's just what happens. And right now the market's down about 19%. That's a big pull down. So I mean, if you think about nearly 1/5 of your of the market has evaporated inside of the last basically this year. So that's hard to swallow for a lot of folks, which is why we draw the trend lines, we use the indicators, we follow our guidelines, and when things break down, we get out. So again, it doesn't mean we're going to sell the top, but it does mean that once we hit a certain level, we will raise cash. And so over time, you can see 19% is, quite frankly, I'd say on average, if not a little bit below average, to some of the other major pull downs we've experienced over the last 2 decades. And again, I don't think we're over yet. I just feel like we've got more room to the downside right now than we do have upside opportunity. So I don't know if this market will turn into a 25% down or 30% down or even 50% down. I have no idea. But what I do know is I'm not willing to put everybody at risk. So we're gonna hold our cash and be ready to push our chips back in when the time is right. Okay, so this last chart here is the Nasdaq, and so where the S&P was down 19, the Nasdaq's down almost 30%. So guys, if you're taking a lot of growth risk in your portfolio, you are getting hammered. We took most of our growth off, and I'm talking aggressive growth off at the end of last year. And so it is, right now it's a hunt for quality. Right now it's stay heavy cash, stay in, good companies that we know are going to be here in 15 and 20 years later, and, are trading at low multiples. And so just aren't, extremely overvalued. Those companies that were overvalued and pricing in lots of future growth, as the inflation rises, it's going to dampen that growth, and that's why they're getting crushed. And so you just don't want to have a lot of growth in your portfolio right now. So, and the thing is, right here, we're down, call it almost 29%. That's not anywhere near any sort of decent support. I think we've got potentially another 8% on the downside before we've hit any real support that's going to allow the market and buyers to come back in. So, I mean, this thing could get into the mid 30s before it turns around. So, very, very dangerous. So again, there's situations where cash is king. So as you can see through all these charts, there's definitely blood in the water. And there's, cash is an asset class, and sometimes it's not appreciated. I mean, obviously during times of inflation, you don't want to stay in cash for 6 months or 8 months. But certainly while there's a lot of turmoil and volatility in the market, it is definitely an asset class that needs to be utilized. And it's one that we've been utilizing now for quite a bit. So we've got very heavy cash positions, and we were ready for this. So again, technical analysis is not about selling the top and buying the very bottom. It's about playing the middle 85% of the field pretty consistently over time. And, so that's our goal. And so when turmoil hits and trend lines get broken and technicals break down, to me, there's no better way to protect than to be in cash. So, that's what we've done. And in doing so, it's a definitive way to protect. So, hopefully you've enjoyed this episode. And of course, if you have any questions or would like any information, or if you're not a client and you would like to get an analysis or a third-party opinion about your situation, we'd be happy to do that as well. So I look forward to seeing you on the next Markets at 5.